Does Warren Buffett know something that we don't? The Oracle of Omaha has a reputation for making calculated moves. But today, his approach is raising eyebrows for a very different reason. Berkshire Hathaway started dumping big chunks of Apple and Bank of America, and is currently sitting on $325 billion in cash, the largest in its history. Is this a warning signal? And what's behind this historic stockpile? In today's video, we will look at the data under the hood, see what we can learn from Uncle Warren, and apply to our own portfolio. Let's break it down. This is not the first time Buffett has opted to hold cash. Before the dot-com bubble, Berkshire's cash holding drastically spiked and subsequently deployed after the crisis to take advantage of the discounted stocks. Same thing happened before the 2008 financial crisis. Buffett also accumulated a large cash position. He then used the cash to scoop up investments at bargain prices. But to get a more complete picture, we can't just focus on his cash pile on an absolute basis, because Berkshire's portfolio size has grown drastically over the years. It is not the same today as it was in the year 2000. That is why we need to look at the percentage of cash allocation relative to his entire portfolio. Currently, Berkshire's cash pile is sitting at 28%, its highest level in the last 3 decades. The last time Berkshire had such large percentage of cash was in 2005, a couple of years before the great financial crisis. Why is Buffett sitting on this much cash? Since I don't have a direct line to Uncle Warren, a better way to analyze this is through his investment philosophy. In 2001, Buffett proposed a metric of market capitalization to GDP ratio. He called it probably the best single measure of where valuations stand at any given moment. This metric is commonly known as the Buffett indicator. Historically, the Buffett indicator has predicted some of the most devastating economic downturns in the US. Before the 2000 dot-com bubble, there was a major spike in the Buffett indicator, and again spiked before the 2008 financial crisis. Essentially, this indicator measures the relationship between the stock market and the overall US economy. Buffett said in a 2001 Fortune article, if the percentage relationship falls to the 70 to 80% area, buying stocks is likely to work very well for you. If the ratio approaches 200%, you are playing with fire. Guess where we are today? The Buffett indicator currently sits above 200%, the highest level ever recorded. Does this mean we're playing with fire and a crash is coming? Not so fast. We might not need to sound the alarms just yet. Remember in 2005 when Buffett had similar sized cash positions? You can argue that Buffett was too early in reducing his market exposure and missed out on 2 years of gains before the crisis happened. Also, the Buffett indicator crossed the 200% level back in 2021 during the everything bubble, where stimulus money flooded into everything from stocks to cryptos to housing. This bubble has only gotten bigger and bigger, pushing everything to new all-time highs, and there are no signs of slowing down just yet. Warren Buffett's investment philosophy focuses on long-term compounding and avoids market timing. He is a value investor known to find good companies at reasonable prices. Currently, with stock markets hitting all-time highs, it is a difficult environment for investors like Buffett to find attractive enough investment in the stock market. Buffett's move to cash highlights his patience and disciplined approach, locking in some profits when a particular bet has paid off handsomely, especially when Apple has delivered a total return of nearly 800% since Berkshire's first disclosed its stake. The move can be a sensible risk-reward trade-off for Berkshire. Buffett's partner, Charlie Munger, said, "The big money is not in the buying and the selling, but in the waiting." So they are perfectly fine waiting for the next big opportunity while sitting on cash. Investing is not just about making money in a bull market. Sometimes doing nothing is the wisest choice, especially when the risk of overpaying is high. Let's be clear. Buffett is not just sitting on cash in a savings account. Much of this cash is parked in short-term U.S. Treasury bills. Thanks to high yields, these low-risk investments have earned Berkshire close to $12 billion in interest. If you want to learn more about Treasury bills, watch my video here. Stock market goes through cycles, and it is generally categorized into 4 phases. It's likely that we are entering into the distribution phase. The distribution phase is when the smart money starts selling their positions. They are sitting on substantial profit, and they're cautious about the market's froth and irrational exuberance. Distribution phase usually starts with euphoria. In this phase, investors tend to be complacent and still have the buy the dip mentality, because they believe the prices will always recover after a dip. In the distribution phase, volatility increases. Just look at the roller coaster market this year, with some of the largest single-day swings. Distribution phase can often happen over an extended period of time, because markets can remain irrational longer than you can remain solvent. The market could choose to ignore even the weakest of economic fundamentals and continue to behave as if nothing is wrong. But when the distribution phase is over, the market reverses direction. A crash can happen in a sudden drop over a short period of time, like in a matter of days or even hours. History has been known to repeat itself. What goes up must come down. We live in uncertain times right now with high interest rates, geopolitical tensions, and economic uncertainty. That is why Berkshire's cash pile cannot be ignored. What can we learn from Warren Buffett's move? Be patient. Don't rush into markets when valuations are high. Prepare for volatility. Be cautious and build your own cash pile to weather potential storms. Focus on value. Remember, Buffett always prioritizes value over hype. Whether this cash pile is a sign of caution, strategy, or something else, one thing is clear. Warren Buffett's actions always hold valuable lessons for investors. What's your take? Let us know in the comments down below. Thank you for watching. I will see you in the next one.